We will be covering four topics in our conversation, which is student demand, investment mood, transactions and financing, and finally product rent levels and costs. And with this, I would probably go to our panelists. And as a sort of first round, I would like to ask you, gentlemen, to shortly, in 20, 30 seconds, introduce yourself and the organizations that you represent, and then we will probably open it up to a conversation. So perhaps, can we start with you, Michael?
Hi, Samuel. Hi, everyone. So I'm Michael. I'm in charge of corporate investments for Ivanhoe Cambridge in Europe across all asset classes, including student housing. PBSA has been on our radar, I would say, for the last 2 years, so it's pretty new. We have already launched together with Greystar and Bauinvest development platform in Paris. And I must say, Nigel, that Greystar has been a good help in forging also our conviction on the sector. So today we are looking to expand into continental Europe, and we are, as you can see, not yet a seasoned investor, but we have now strong convictions. So thanks a lot for having me on this panel.
Thank you, Michael. And if you can go in the order of as the speakers were listed. So we go to Nigel now, please.
My name is Nigel Alsop. I'm head of research here at Greystar in Europe. For those that don't know, we're a rental housing specialist. It's important to know as well, we're vertically integrated. So we're an operator, an investor, and a developer. Globally, we have about 700,000 units. In Europe, we have about 30,000 units. A lot of those are in student housing, particularly in the UK, but also across continental Europe. And thanks for having me.
Thank you, Nigel. Stuart, over to you.
Morning all, I'm Stuart Moore, I'm the CEO of CRM Students. We operate student accommodation across Europe, so UK, Spain, Portugal, opening in Italy, mobilising in Italy this year for opening in 22. So good growth, good data, because we host a lot of internationals, as you can imagine. So looking forward to this morning.
Thank you, Stuart. And Dan, if you can ask you for your introduction.
Good morning, all. Great to be here and hopefully celebrating the end of what's been a tough 18 months for us all. So my name's Dan. I run the EMEA side of Student.com. Student.com, we're a student accommodation agency. So we have teams all across the world, in Asia, Europe, North America, South Pacific. But we grew up out of China, so that's where we started. We've now got 150, 200 people still out in China. So it's our main corridor to the rest of the world, but we have a true kind of global perspective on everything. And looking forward to talking more.
Thank you. John, thank you for coming. Can you introduce yourself?
My name is John Lishman. I'm one of the Pro-Vice Chancellors at Coventry University. Coventry University, based in the West Midlands of the UK. It's a large university. Has a large number of international students. It's one of the largest largest universities in terms of international students. We have a main campus in the West Midlands, and we have campuses in London and the north of the UK as well. Also, slightly unusually, we have a European campus. We opened up last September in Wrocław in southwest Poland, and we are very interested in working with partners and providers because of the interest there is coming into that part of Europe from not only outside the EU, but within the EU as well.
Thank you, gentlemen. And I will probably start with the student demand topic. How does your experience in 2020 and now heading to 2021 school year, how does your experience relate to what Martin presented and the hard data from occupancies in 2020 and the student application for 2021? Does it copy your practical experience? And John, can we start with you?
Sure. Yeah, I mean, it's interesting to see the data. That does pretty much match where we were. We anticipated a bigger fall off in terms of international students coming into the UK than actually materialised. So we were roughly about 85% of what we expected. We predicted around 50%, so we did better than that. Of course, quite a lot of those students are working overseas. They've stayed at home rather than coming to the UK, and our occupancy rates are at the lower end, about the 80% mark in terms of student accommodation. Poland, it's too early to tell, except that applications into the UK from international students are about 2% lower than they were in 19. So that's really recovered from where it was last year. And growth is slower in Poland, but there's a lot of interest from both Poland and the EU. About 25% of our students are from outside of Poland, but in the EU, and 25% of applications are from students outside the European Union. That's interesting for us. The big numbers you would expect are from Baltic states, from Ukraine, Belarus, but also, pleasingly, we're starting to make inroads into the Indian market. And the Indian market is probably the hottest market for us, both in the UK for international students and within Poland as well. So having what seemed like very much doom and gloom over the last 12 months or so, we're pleasantly surprised about how the market is recovering, given that we're not all out of this pandemic by any means. It's looking very strong.
Thank you, John. And seems like students continue thinking about studying and studying abroad. Nigel, you have, as Greystar, assets all over the continents and countries. How did your occupancies hold up, and what is the take-up for next season?
Yeah, so I'd echo, I agree with the presentation. It's certainly, I'd say, beat expectations, and it's been a bit of a relief. It's quite interesting if you just wind the clock back a year or so and look at the headlines from, say, February or March, April of last year. Certainly, I felt there was a bit of a media panic. And there was a suggestion that study would kind of change forever, that the whole thing would go online. And a lot of the analysts, the sort of street analysts, were suggesting that certainly the UK operators were going to see occupancy of less than 50%. Actually, what we saw was more like 3/4. That's economic occupancy, not necessarily physical occupancy. So it's surprises. I think the key difference for us has been in the short-term performance has been between the UK and continental Europe. So we've seen much stronger performance in continental Europe. There we've seen occupancy, important to know that's economic occupancy, in high 90s and low single-digit growth in those markets. And I think that's a function of two things. Firstly, less international student exposure. So travel bans have been less of an issue, but also probably slightly less heated market. And in some markets, notably the Netherlands, where you've got regulated product, that's actually been our friend throughout the last year. So in summary, yeah, pleasantly surprised / relieved at the performance of the last year.
Stuart, as Nigel touched it, there is a physical occupancies and there is a financial occupancies. So contracts versus how many people collect the keys. And you are probably the greatest operator in the UK and the continental Europe in terms of size. So how is your experience in occupancies in general, and then the difference between the financial occupancies and the physical occupancies?
We were over 80% in across our portfolio. We were slightly lower in Poland, which reflects what John has said. But in reality, again, we were very lucky because we started gaming this as soon as we saw problems arriving in January. So what we carried out, and that's January 20, what we carried out was a series of programs to ensure that we contacted all our overseas students to ensure that they were still continuing to come. And that continued right up until pretty much the end of September last year. What that enabled us to do is to set our physical occupancy and our booking occupancy, or our financial occupancy, to be pretty much within 1%. Operators and platforms that didn't do that, did see some struggles of where they were still seeing people oh, well, are these guys going to turn up, and et cetera, et cetera, et cetera. And I think that's going to be where I think there's a lot of learnings from last year to going into this new academic year in 21, where I think more people are going to be much more cognizant of this occupancy gap, shall we call it. What's interesting, I think, going into this new academic year starting in September is that we're already seeing our bookings matching that or exceeding in some cases 2019's. So I think there is renewed confidence, and that's particularly in the UK. So as the UK government unlocks elements of the UK, we start to see spiking bookings. What we're not seeing yet, though, are internationals booking. So it's not quite reflecting what universities are seeing in terms of demand. I think what's driving that, and we've seen evidence working with some overseas parts of the government, we're seeing students from Far East or South Asia booking in multiple countries. And Martin touched on this in his opening statement. You know, what's the image of safety? What's the image of the destination? And I think what's going to happen is we're going to see students potentially reserving places at universities around the world, be it the UK, New Zealand, Australia, if it ever opens again, Canada, and the US, and then choosing where to go. So I think from an accommodation point of view, we'll see a very busy August, September, and October.
So late bookings, late decisions. So demand is there, but the decisions will come much later than.
Demand is really there at the moment with domestic students in any country we operate in. Our domestic students are way above where they were in 2020 and exceeding in some places 2019. Our internationals are still waiting to see what happens.
Thank you. Before we go to Dan, and then Student.com is sitting on multiple territories, who will probably have something to say on the destination shifts, etc. Richard, can I ask you to pull out the first polls? And I will probably read it for those who are following us from the phone and might not necessarily see the polls. So the first question is, what percentage of students who booked their stay in 2020 actually turn up? We are asking about the difference in between the financial occupancy, so contracts, and physical occupancies, so those who collected the keys and really came. So once again, what percentage of students who booked their stay actually turn up physically, not only paid for the accommodation? We have about 27% people voted, so I let it run for some time, and then if I can go to you meanwhile. So when you compare now 2021 and the take-up for next academic year, and you compare it to the previous 2 years, how does it compare?
Yeah, it was really interesting hearing Stuart's thoughts actually, and how they're seeing the international market. I think May for us has been a real shift in terms of kind of getting back to business in inverted commas. You know, I pulled some stats to share before this, but, you know, looking at our Asia to Europe numbers, we were 76% down in January, 39% down in March, but May is now over 120% up month to date. So we're seeing this huge, obviously, compression of demand into these last kind of 2, 3, 4 months of the booking cycle, obviously because people are waiting to see, you know, where the pandemic is in certain countries. They're minimizing their risk by not booking early. I agree with Stuart that, you know, we'll probably see people booking multiple countries for the first time, as opposed to at least having a country in mind. So that's really interesting on that side. But yeah, I mean, May for us is above 2019 numbers now. But it's hard to say whether that's, you know, the macro number of students going abroad or just the compression into a short booking window at the moment. In terms of, you know, particular countries, the UK is flying. I think it's, you know, testament to the vaccination program and actually pretty good communication strategy for the first time from us, to let people know, you know, what's going to happen, and universities being open this week should be a really kind of good kicker for that. Europe is interesting. So we're seeing, you know, opposite trends. So You've got countries like France, which are still in a slightly different stage of COVID. I thought the vaccination number you shared earlier was interesting, as it was basically the only kind of large country in Europe that was going to be not anywhere near 100% by September. So I think potentially that could explain that as well. And then we have countries like Spain and Germany, which are absolutely flying kind of similar growth numbers to the UK for us, particularly from Asia. Lastly, I think India is going to be a challenge and a question for us all. Obviously, with the situation over there, we have a team of 40 or so in Bangalore, and at one point, 8 of them had COVID. So we had 20% of our team off at the same time with COVID, and I think it's way worse than it was here in the UK over there. So their ability to travel could be a real challenge for countries like the UK that have invested pretty heavily in this Indian market to fill the gap for the EU students not coming. So I think we'll have to wait and see. But to me, that's probably our biggest risk at the moment, is the thousands of Indian bookings we've done that are potentially going to all be cancellations because they're not going to be allowed into countries.
And one more sub question over here. You are very strong in China. So how does the Chinese market performs in your bookings, and specifically in correlation in the destination shift? So there are some political issues in between China and Canada, so that affects the booking patterns already 2020 and 2021. Australia and New Zealand is not as open as the Chinese would probably want to. On the other hand, Canada, at least based on our research, will walk out the best out of the pandemic. It will become the probably most preferable destination with 8% increase. So how does your bookings look like in this regards?
Yeah, I think it's fair to say we're seeing exactly the trend you describe. So Australia and New Zealand, for all intents and purposes, is not a thing for the Chinese customer for this year. They're not even considering it. There were some trials to get international students into Australia, and then COVID leaked from the quarantine hotels, and those trials got wound back pretty quickly. So, when you look at the Chinese nationals, they're very risk averse, so they'd also be concerned about that and not wanting to travel. UK is absolutely flying. I think it's benefiting from Australia and New Zealand, political issues in the US as well. Visa embassies for the US being very slow to open up as well. I think they've addressed that in the last 2 weeks or so for that to change, but perhaps it's too little too late, I think, for that. The students probably made up their mind in March or April that they were going to shift destinations. So the UK should have a really bumper year for China. And we're seeing exactly the same to Canada as well. So Canada and the UK are super high growth. The US is probably 40-50% down from our data, although it has picked up massively in the last 2 weeks. And then Australia and New Zealand is basically a zero for the Chinese customer right now.
Thank you. I will share the results of the first polls. And we can see over here that the difference in between the financial occupancies and physical occupancies was about 20 to 30% mostly, which pretty much copies what we are hearing from the market. At the same time, I would probably ask you, Richard, to put a second polls on a screen. So this one is about to what level will we see students arriving on site in September 21 when we compare it to the maximum potential of students that can come. So if we have no COVID and everybody would come, what's the confidence about next year in terms of physical arrivals of students? Therefore, also those who will need housing. And with this, I will probably move to investment mood. So I will introduce it with our statistics that in October, we had 2020, about 62% of investors wanted to invest more. So the investment mood was quite confident. 25% were on hold and 10% wanted to divest. When we did similar polls in February 2021, that increased to 75% of investors wanted to invest more in student housing. So we'll see where we are now, and I will probably invite Michael to the conversation now, not only as a very strong institutional investor, but also an institutional investor who have recently created a very strong 1 billion platform for student housing. So what is your context and your thinking about student housing, Mike?
It's been both conjunctural and structural conversation, as you can imagine. We had started this platform story before COVID, obviously, because we were very much convinced by the structural tailwinds of the sector, which I'll come back to. But then when COVID hit, to be fair, and that's maybe a more naive question from an investor that is more generalist than focused more on PBSA, is, was student housing going to be among the winners or the losers of COVID? And there was a real question mark in March, April 2020. Would it be like hotels? Would the students just go away, gain money to be able to study at home? Would remote classes become the mainstream story? And to be fair, it was a real question. We were not convinced either way. And we were finally amazed to see the numbers of 2020. I mean, the sector has been heavily resistant, and we could even say that it's now today a winner of COVID. Because where we stand today is we all want to get back to normal life. It's not I'm having a great time this morning, but we're all a bit sick of Zoom story all the time. We want to get back face to face. And there's been a lot of press about that the most depressed category of people today in Europe are mostly young people that are not able to see each other, that are not able to exchange. And that's why I'm convinced occupancy has remained super high through 2020. First of all, because people wanted to stay together. And when you think about it, you couldn't be together on university campuses. So where could you be together in those kind of assets? And the second point why it stayed high, we think, is a more structural point. We have discussed a lot about demand, but I would say that the biggest part of our investment thesis is more regarding current offer and the lack of supply, and even more the lack of good quality institutional type supply. And that's where we see the biggest opportunity. And I also think that the students that are not stupid also want to keep their place in where they are. They don't want to lose it because they know how hard it's to get into those type of good quality assets. And today, what we have seen, and please correct me if I'm wrong once again, we have seen that there's a huge lack of quality supply. A big part of the current supply is state-owned or subsidized, and it doesn't offer the type of quality you would need today for the kind of demand you're seeing with a good quantity of services, with good quality of even bandwidth for internet, with and the good size for institutional investors to invest in, meaning maybe more than 200 or 300 beds per asset. And in most countries, of course, they already exist, and you have a lot of good quality operators that have been developing those assets. But there's a huge ramp up still to come. I think that there's still a huge place for those specific assets to come into the market. And that was definitely our investment thesis for city like Paris, where Paris, you have a lot of students, but you don't have today the offer for them. And they're willing to pay for those kind of assets. And there's a huge demand, obviously. And the other structural tailwinds that we have seen for continental Europe is also that Brexit and the expensive side of the universities in the UK, and given in the last 18 months, probably people are becoming more cautious about their finance. makes the investment thesis more interesting for continental Europe, where tuition fees are less expensive, and probably students with the Erasmus program are going to be more and more looking to study in the European Union. So given that potential increase in demand and the lack of supply, we believe that there's room for institutional investors to create and to expand into those type of products. So that's what we're currently looking for. And today in Paris, that's the first step, and hopefully we'll be able to do more.
Thank you. Just to complement it, out of the 8,800 buildings that we monitor globally, only 2,400 are private PBSA, and only probably half of it is an institutional stock suitable for institutional investors with 250 pets and more. And out of the new stock, only 10% is built by universities, but 90% is built by private sector. So private sector is taking over to meet the new demand in terms of quantity as well as quality, because the old stock, public stock, is not suitable for new students or current students in all the amenities and the facilities and Wi-Fi that you mentioned. But with this, probably, Stuart, you must be talking to many investors, and for many investors, you operate buildings. So does Michael's experience as an investor, so Q2 2020 doubts, but then Q3, Q4, and increasingly more so Q1 and Q2 2021, is the investment confidence increasing, decreasing, still doubts? What is your experience?
It was quite strange. There was a lot of activity, but nothing was really moving. If I was an agent now, I'd be thinking, I'm not going to be able to take a holiday in Q4 this year. I think there's going to be a lot of transactions at the back of the year. I think there are still some investors that are a little bit apprehensive about what's going to happen in September, October time. So I think they just want to see what's going to happen. But I really think that we'll see a lot moving in Q4. I think we'll see a lot of transactions occur before Christmas or the end of the year. I think there is still sentiment that this sector, co-living and build-to-rent, are effectively resilient to many external factors, particularly when you compare them to what was the gold standard of retail or high street. Living product is a safe product, and I think that's really what's proving right. Purpose-built is simply a subset of that, and I think the confidence is there. We've had 3 people come to us this week already saying they're looking at new product, can we price it up? And we're only on Wednesday. So it's really kicking off. It's really, really positive, I think, for the market.
I have to say that we have the same experience. We have much more work now as people see that the sector is recovering, and there's much more capital available, many more investors, and many more need for data. So we are usually at the beginning of the cycle as we do the assessments and risk mitigation, and the doubts are fading away. But yet still, some people are waiting for September, October. Maybe with these to Nigel, as Greystar has properties all over continents and countries. Do you see that in terms of investment, there will be some shift in demand for particular territories? For example, we see enormous demand for Germany as a safe haven. Even though the yield spread is low and the cap rates are already at 3.4, but still, it's more than probably 4 billion looking at Germany now to invest as soon as possible. But what is your experience in terms of preferences and locations?
Sure. So maybe if we just start with the broader market, or particularly the UK market, it felt as though last year investors kind of tapped the brakes. So they put their plans on hold while they just saw how things shook out with operating performance. To Michael's point, I think people are very reassured, and the investment thesis of student housing is if not a counter-cyclical, more of an acyclical asset class. So what we're seeing is more and more people coming into the sector, some new entrants actually, increased competition for deals, changes in strategic asset allocations, and that's meaning that that capital is kind of spilling out across Europe now. Now that that investment thesis, I think, has been proven out in the UK, people are then starting to say, well, how does this work in other markets? So already active in the Netherlands, Spain, France, and Austria, and also in Germany as well. And there, I think people are just trying to get their heads around the differences, right? Because there are some key differences between the markets in terms of things like permitting, so whether or not it is actually a separate asset class, regulation, demographics, those things vary quite a lot. But I agree, I think Germany makes a lot of sense, but for slightly different reasons. I think their rents are probably much more affordable. It's a potentially huge market, and the provision rate is phenomenally low. I think it's probably sort of lower than 10% at the moment, where when you look at the more developed markets, like the UK and the Netherlands, it's more like 25%. Now, for those that don't know, provision rate is a ratio of beds to students. So a provision rate of 25% equates to 1 bed for every 4 students. So those markets are still undersupplied, but Germany is significantly undersupplied as well. So yeah, I think people are going to look to kind of spread their wings, as it were, and look at these different markets, each of which has slightly different characteristics. And interestingly as well, just to finish, that it's interesting to see the variance in valuation over, say, multifamily across different markets. In some markets, you can see very narrow spread between multifamily and student, because local investors see it as essentially as kind of the same as multifamily. In other markets, you can see 100 basis points of spread. And so it looks very attractive from a returns perspective. But in short, yes, I think the investment case has been proven out in the UK. People are now starting to look more to continental Europe.
The other thing we can see is that the sort of confidence about the asset class and the pressure of the capital, new capital, that people are sort of reparking from retail or office to living asset classes, as you mentioned, is that even the institutional investors are moving from core plus to value add, an opportunistic approach because there are not that many opportunities in operating stock. There are only 190 portfolios. So there is not so much to transact if they want to park a bigger chunk of capital. So it's a huge chase for new opportunities, new developments, which is quite new. That institutional capital is looking for developments. So with this, I would probably publish the results of the previous polls. And right, for those who cannot see it, are on their phones, I will read it. So to what level will we see students arriving on site in September 21? So compare the maximum potential to physical arrivals. 90 to 100%, 22% of people believe that. The majority of the crowd, 52%, believe it's 80 to 90% of the students will arrive on site. And 18% believe it will be 70 to 80. In a short, basically, what is it? 70, 80, 90%, 92% of the audience here believe that 70% and more of the students will arrive on site. So that's basically the outcome. I would move to the third topic, which would be around transactions and financing. And over here, probably again, I would call Michael with little introduction. What we have seen so far is that the yields have stayed the same or compressed. The LTVs shifted about 5%. So let's say if it is 60-40 in some countries, it is now 55-45. And the deals are on hold, as it is difficult to sort of visit the site physically. So some of the deals went through, but not as many. And so the liquidity is halted or hindered a little bit. On the other hand, we have a feeling of a potentially pent-up demand, as Stuart mentioned. How do you see Michael, the asset class. Do you think upon the current demand, it will be more pricey, and the asset class in 2022 will be actually more expensive to enter?
I should say no, so that when people delay their acquisitions, but that's because I'm afraid it's going to get more pricey indeed. I mean, as I said, once you have the good quality assets, the product that the institutional investors are looking for, and even bigger transactions, yes, it will be a great battle to get a hold of them and to acquire what we're actually looking for, because of what we said previously, the lack of product essentially, and the convictions that we have. We believe it's going to get more pricey. The COVID situation maybe is holding a bit some banks, holding a bit some investors. But as Stuart said, September, October will be potentially unlocking the potential when we see that figures are coming back up to normal. There's a big question mark for new developments. We've seen some assets being delivered in 2020, 2021, not getting the full potential of their reservations. So if we get reassured by those and the level of reservations in September, this will unleash hell on the investment market with a lot of very interested people with probably lower and lower cost of capital. So I hope this is getting delayed, but I think that it's going to come. And I think that when you're able to develop the correct products, you'll find investors and you'll find banks willing to take the risk with you. The banks get reassured not only by the products, but also by the location. And most of location, for example, what we're doing in Paris, they also get reassured that if someday student housing, for whatever reason, doesn't work anymore, you can also transform it into resi, classic purpose, rental purpose built. And that's where they get reassured. And that's where you can probably achieve 55% loan to cost with a decent margin. That's what we are seeing right now. So that's my personal view that, yes, it's going to get more competitive.
Mm-hmm. Nigel, what do you think? Are we living in a pent-up demand for more investments and transactions, or this will be just a smooth increase? Or
Definitely the first one, I think. I think if you just take a sort of step back, even pre-COVID, we saw rising allocations to alternatives, and within that, rising allocations to real assets. And I think even before COVID, there was about $1 trillion globally of dry powder sat there ready to go into real estate. So there was already a lot of pent-up demand. What's happened, I think, through COVID is that people have rethought their strategic allocation. Now, it's a cliche to say that COVID has accelerated a lot of pre-existing trends, but I think it's true. I think people are making that shift out of traditional commercial real estate, such as office and retail, which is something I used to cover for the majority of my career, and into so-called beds and sheds strategies. The problem you have with that is that, say, pre-COVID, the sort of beds and sheds made up less than a quarter of the market by transaction volume. And so what you have is a lot of capital trying to get into a relatively small hole. A simple way I would think about it is that dry powder now is about 2 times where it was just before the global financial crisis. But the menu of assets has essentially shrunk by half. And particularly with build to rent and multifamily. So yeah, I think there's going to be a lot more pressure on yields. One final point as well, actually, is just to note on yields and spreads. People often talk about yields or cap rates being at historic lows, which is true. But when you look at the spreads over the 10-year, it's still near historic highs. So on a relative valuation basis, it still looks very attractive.
Stuart, you as an operator are a critical point in underwriting of many assets. Do you feel the same?
Yeah, I think it was very interesting what Michael said actually about mobilizing assets. I think as we see more and more kit arrive in the market, I think we're going to see a slightly longer stabilization period. And again, quoting Nigel, I think we'll see this accelerate. We expected that a new building would be seen as being a safer option. Nobody's been in that bed before. Nobody's been in that communal space before. But actually, the lack of reputation or the lack of social media around existing assets is actually slowing things down. So that's, I think, quite an interesting point that both Michael and Nigel raised there. I think the amount of kid arriving in markets is good in some ways, but I do think it's going to take longer to stabilize. So I think what we'll see from our underwrites, depending on the client, we'll start to see anything from 90% to 95% to the industry norm of 98%, and clients will choose where they put their risk levels around that, and I think that's going to be the new norm, I think, going forward.
Yeah, it's probably one information in relation to what also Nigel mentioned, that we see from the big data that 2 years ago there were 650 assets in pipeline to be developed in the next 3 years. That's the visibility that we have, and now it's 839 assets. So it's sort of 30% increase potential stock to invest in new developments. So it's driving the capital to new territories because there's not so much to transact in existing stock. But the consolidation of occupancies might be probably more cautious. And
I think that's very true. I think if you look in the Q&A, there's been some questions around secondary and tertiary cities in Italy. And that's where we'll start to see movement. They'll go to secondary and tertiary cities. And I still think they are very attractive to investors, and they're very attractive to operators that have shared interests. But they have to be priced correctly. And what we've seen in other territories in Europe is that actually it's got overheated. So the rents have really pushed very high that eliminates all but the wealthiest of international students.
Yes. So with this, I would probably conclude in the transactions and financing topic with the third polls. Richard, if we can ask you to pull out the third, number 3 question. So the question sounds, what's your view on transactions and new investments from the upcoming academic year? So will the investments decrease, same level, increase, or significantly increase? It means we have a pent-up demand. And while we are voting over here, I would probably come back to John and then now speaking about the product, rent levels and costs onwards. And then I will also pull out some questions from chat and Q&As. So if you have any more questions, please put it in chat and Q&A. Then, in terms of product, do we see any different patterns in bookings? For example, more for single rooms or studios or single and suite rather than shared than we saw previously? And do we see the same pattern? I remember I had the chat with Luke, your CEO, about 6-7 months ago, that was definitely the trend before September 2020, but do we see the same for 2021?
Yeah, in a one-word answer, yes. The trends are very clear to see, and I think they're kind of as we expected, if I'm honest. So we're seeing students spend so far about 6% more on their rent. Our average rental fee has gone from $7,100 to $7,600. Now, obviously, that's not sustainable because not all of the prices have just gone up by 6%. So people are clearly booking the larger rooms or the more luxury rooms and experiences or properties at the moment. And I think, well, we've spoken to many of our students and understood why. The students are obviously expecting to spend, even in a post-COVID world, in somewhere like the UK, which should, in theory, from mid-June have no restrictions at all. I still think students expect to spend a lot more time in their rooms than they would have done 2 or 3 years ago. So they're willing to invest and spend more on making sure that home environment's much better and much more, or that they have the best environment they can, essentially. we're seeing a lot of demand for facilities. So if a student can have a gym on site or a cinema room on site and these sorts of things, it is very preferential. It stops, I guess, for them, it mitigates risk. I think, all of us have probably traveled plenty in our lives, but, I'm certainly going to be slightly different when I travel post-COVID. And I think students are very risk averse right now until kind of the first round of students go into this post-COVID world. And then obviously the other big trend we're seeing is a huge drop off in twin rooms. So, in some markets, European markets coming to the UK, or Americans going to Europe or the UK, twin rooms were very much a thing. And now, that's all disappeared, particularly over the summer for us, we found. We typically have a lot of American groups that come into the UK and Europe over the summer, and they prioritize twin rooms for low cost and to minimize the rental fees. And that's just absolutely disappeared. They all want en suites, they all want private rooms to obviously protect the students if they have to self-isolate, or to minimize the risk of spreading COVID if there is an outbreak between the groups. So yeah, I think that there's a pretty large change in what we're seeing preference-wise. Whether it will revert back in 12 months, 24 months time, I don't know, but certainly for the year ahead, I think students are prioritizing more space and higher quality.
Great. John, you have Coventry University has a great stock of accommodation. So while Dan is representing mostly the international students coming to the destinations, you have a lot of domestic mobile students that are booking your accommodation. So how is the trend here in terms of their preferences? Do you have a problem to fill the double rooms or shared rooms, or not at all?
I think the way Dan's described it would be pretty much our experience. I can't pretend to be very close to this, but that's certainly how I've seen things more recently. I think the point that was made about the quality of the room, because students are going to be spending much more time in the room. I think one of the things that the pandemic has taught us is that, there is demand for students to come back onto the university campuses. But they also like the opportunity to study using Teams and Zoom and that sort of thing as well. And we're shifting our pattern delivery to accommodate that. Students, I don't think, will stand for too much longer for large lecture theatres. And that's also a COVID issue as well. Students are reluctant to come on to the campuses to a certain extent. To an extent, we expect that to continue. So the importance of, certainly in terms of high quality accommodation, there's no, that's a huge impact in terms of attracting students to the university, that we can show them the accommodation, whether it be our own or other providers giving, and it has to be of a certain quality, because the expense for international students to come and study, for home students to come and study, is so great now that they expect the whole package in terms of accommodation. We've had a massive increase in terms of private student accommodation over the last 3 years, so about 17,500 beds within the city itself, walking distance from the university campus, and those are everything from large studio flats to twin rooms. But certainly, overall, the quality of the room is getting increasingly important, and added to that, the increasing use of studying from your bedroom rather than coming into a lecture. I think it'll push it in that direction.
Stuart, you told me when it was December, I think, that even if you deployed some discounts on shared rooms, you had difficulties to fill them. Is it still the case now for September 21?
Very much so. Very much so. We thought that the shared rooms were finding it tough anyway, and then COVID's, again, horrible phrase, but it's accelerated that. What we have found though this year or this booking season for September, is that non-ensuite rooms, so a maximum of 2 sharing, are starting to come back. Now it might be, and I think this is very important, moving on from what Dan said, is that actually I think we're going to see 2 distinct strands come from this market. I think we're going to see a very much high-end, all singing, all dancing type product. On the Q&A, we've got a couple of questions about affordability. And I think we're almost forgetting that actually this has been a financial issue over the past 18 months, as much as a lockdown, as much as a disease. There are a lot of people in domestic situations feeling the pressure of finances here. So I think there is a real opportunity for a value product to be put out there as well. And again, I think that's where the non-ensuite's coming from. Whether that trend continues past the next 12, 24 months, I don't know. But what is for sure is that at the moment we're seeing, not just in the UK, but in continental Europe, we're seeing the domestic students snapping as much as they can at that value product. And we're waiting for that international market to come in and take the more expensive elements of our portfolio.
Yeah, I see one of the questions here from Sienna, Colin, that basically which way we should go, to build more affordable accommodation or more quality product and higher end levels.
I think it depends where you are in which city. It depends where you are in that city. And it depends on the audience that you're targeting. If I was in the middle of London in zone 1, then I want to charge high rents. I wanted an all-inclusive product, a really high specification product. If I'm in zone 4 and zone 5 of London, or Barcelona or Madrid or Berlin or wherever, then I want to do an affordable product. If you think about the car industry as a whole, you sell a lot more Kias than you sell Rolls Royces. So the market is much higher there. And likewise, in the student sector, there are a lot of students that can afford that Kia product that can't necessarily afford the Rolls-Royce product. So I think we're going to see that splitting of product types. Whether that's good for both the industry and for the universities, because you don't get that blending of students in the accommodation, that's a question we'll have to wait to see to answer.
Mm-hmm. Nigel, in your sort of bookings, your properties, does it copy what Stuart said and then?
Yeah, I'd say so. I mean, we've always had a preference for studios anyway, and but not because of, obviously not because we saw COVID or anything like that, but more because those have just performed better. And I think, like to Stuart's point there, there's lots of, it's a big market, right? There's like 600,000 beds or something like that in the UK. And so there's an opportunity for lots of different product types for lots of different customers. I think there's enough room to play for a domestic market that might demand something that's more affordable, that post-COVID will, like, it's just more economic to share than it is to have your own. Equally, there's a growing market of international students which demand something quite different, something a bit more expensive, to Stuart's point, some surprising rents they're willing to pay in central London. And then, of course, you have to add to that, postgraduates, young professionals that have just left, in markets where the permitting is a little bit blurred. But all to say, I think there's room for the asset class to develop, because, so if we roll back the clock a few years on residential, people used to talk very broadly about residential. Now we talk about residential in terms of build to rent, in terms of single family rental, in terms of student housing, in terms of senior housing. I think these asset classes are just going to splinter into more and more subsectors in exactly the same way as happened with office and retail. I mean, there must be half a dozen different types of retail. And I think the same will be true of residential in general, but student housing in particular will start to talk more about affordable product, as is the case with sort of build to rent. And we'll also start to talk more about premium product. And that, what market you're in, will dictate the product type. And it will start to look more different, I think, and more diverse.
Dan, if I can ask you, we discussed a single versus shared room preference, and I see some questions in Q&As. related to whether also there is a shift in terms of preferences of location. So, for example, closer to a university or closer to downtown, or any light you can shed over here?
Yeah, sure. So I think it's so location, I think, is a secondary factor to quality right now, comparatively to, well, in terms of a shift. Now, obviously, location is super important to a customer, and I don't want to make the mistake of sounding like I don't believe that. But you obviously don't necessarily get the best quality right next to the university based on where the assets can be built and where the new PBSAs are and so on. So I think, to be honest, we're seeing a blend of both, where in an ideal world, people would like to be walking distance to the university so they don't have to take public transport and so on. But again, that's not always realistic to have the high spec that they want as well. So yeah, I mean, it's probably a bit of a wishy-washy answer, if I'm honest, because we're seeing we're seeing both. People wanting to be walking distance to unis, but also wanting the high spec, which isn't always available next to the universities.
If I could just jump in just to add to that, if that's okay, Sam, I think that's really insightful. I think what's happening is that residents generally, and students in particular, their kind of utility function, so the way they think about real estate has fundamentally changed post-COVID. I think the single most important factor, and this is, I guess, this isn't just my point of view, it's sort of validated by a Knight Frank survey of students, that when they surveyed the students, they asked them what was the most important factor. Number 2 was the size of the room. Number 1 was Wi-Fi. And that is something that we have found, like whether you're talking about domestic students, foreign students, whether you're talking about premium product or affordable product, or whether you're close to campus or far from campus, the common denominators at all is that you have to have a minimum threshold of Wi-Fi. Without that, it's just it's like not having running water. So I just had to jump in and add that, because it's a really big theme as the feedback we're getting from some of our tenants.
Okay, before I move to costs and rents, probably, Richard, if we can ask you to publish the results of the third polls. So for those who are on the phone, I will read it. What's your view on transactions next year? So new investments in the upcoming academic year. Decrease 7%, same level 20%, increased 59%, significantly increased pent-up demand 16%. So basically, 75% believe that it will increase or significantly increase next academic year. So we might be experiencing additional pressure on price and yields. Speaking of this, I will probably move to rents itself. You mentioned then that you saw a 6% increase. Our research showed that many of the properties are at the same level or increase the rent next year. So there is confidence to have occupancies that they don't need to discount, only about 20% discounted. And many of them are publicly listed companies with nominations that they had to in many cases. So Stuart, your view on next year rent levels, will they stay same or increase or decrease?
I think it would be a real mix across the board. I think if you're a domestic, I know this sounds sort of oxymoronic, but if you're a product aimed at a domestic student, I think you'll see prices increase. I think because international market was very flat last year across all territories, I think you'll see them stabilize this year and then try and accelerate in 22, 23, purely because you haven't got that rebooker rate. You haven't got that number of first years moving second year and second to third. And you haven't got that social media, that buzz about the building that enables you to get 20, 25, 30% of your beds away to existing students. So I think that's where we're going to see some price shifting. I think the best market to watch and the most interesting, and I'm glad I'm not there, is going to be Dublin. Dublin has obviously had real issues with occupancy this year, but it's also suffering from the rent cap. So our operators and owners are going to increase the rents, thinking, well, that enables me to keep on my business plan, that enables me to stick with the cap, or am I potentially affecting occupancy with that? So I think that's going to be an interesting market to watch. I think rent cap markets are going to be interesting to watch. But overall, I think you'll see the popular rooms, the rooms that are filled and have filled over the past 18 months go up in price. I think the international market, those high-end rooms, are probably going to stabilize and then accelerate towards the end of the booking season.
Mm-hmm. Nigel, what is your view?
So our experience has been, so if I start with the UK, we're sort of really, rather than, because you've got this huge base effect from last year, we're really measuring against 1920. And so there we'd expect sort of low single digit growth, but it really kind of depends on occupancy across the rest of Europe. If you just looked at the operating fundamentals and you didn't know there was a pandemic, you wouldn't necessarily know that much was wrong. So as I said, we've seen sort of low single digit growth throughout the pandemic. And I think that's two things. It's partly in those markets where there's been a higher proportion of domestic students or a lower proportion of international students. And that will kind of carry on. It probably means you have slightly less long-term growth because you have fewer international students. The other important feature, I think, and Stuart touched on it, is regulation. So our Dutch assets, where they're regulated, the rents are kept sort of necessarily affordable. That's why they're kind of regulated. And so whilst that, you might miss out on some of the upside at some points in the cycle, during the leasing phase, it's proved particularly well. So there we leased up an asset just over a weekend. So there we'd expect to continue to drive performance, but it's kind of steady Eddie, and it hasn't really changed that much throughout COVID. So in summary, we expect the UK to continue to sort of outperform. Regulated markets they've kind of kept at the same kind of pace, really.
And speaking of this, probably Paris is a very specific market, and then Michael can comment on that we have a regulation on the rental product in general there. On the other hand, the new stock can set up a new standard, and in terms of rental levels. So you all together with Michael, you can be in a very good position to bring the new stock at a new price levels, as we have 10 students waiting for one room in Paris in general. So the demand is enormous. So the regulation is holding up the existing players because they don't want to invest the 50% of NOI to renovation necessarily to avoid the regulation. So how do you see this particular market, Paris, in terms of rents?
Well, there are, to be fair, the rent cap in Paris is really for inner Paris. And you have opportunities just outside of Paris to invest in really attractive places where you have large university campuses, well-connected cities, where there's no rental cap yet, let's say. Also, there are different ways to set up your contract. You can be either on the resi type of contract, but also on the commercial type of contract. So it's up to your choice on how you develop the asset and what type of building permit you apply for. So that being said, there are ways to control. You cannot avoid, but you can control, and you can at least plan properly for the type of rent that you're going to achieve and the type of rental increase you might get. And that being said, the biggest driver will always be the lack of supply. So the rents will be driven when you sign a new tenant, will be driven by what they can get for what type of quality and for what price. And our ambition is definitely to build the best products that will be available for them. And sure, we'll be on the high side of rents, but we do have the ambition to achieve the 95% occupancy Stuart mentioned. Probably not 98, as you said, but I had a question for you, Stuart, on that is maybe people used to do 98 before and now we underwrite 95. I agree with you on that, but isn't that a bit offset by the fact that some people are underwriting huge rental increase throughout Europe. And in fact, you see underwritings that come up on the higher side, or do you think that the 90% occupancy will drive underwriting on the downside?
I still think on an operating asset that is run well and managed well, we'll still achieve 98 plus occupancy. I think for a mobilizing asset, I think 90 to 95 is a relatively realistic number nowadays. If I was delivering a site in Coventry where John is, I'd be looking at probably 85 to 90% there, if not lower, because the challenges are you're in a market where there are 17,000 other beds. So I think that's much more difficult to get going there.
With this, probably, Richard, if you can pull out the last polls on over here, which is very clear. What will be the impact on rent levels in next academic year? So rents will decrease and discounts will be seen, or no increase, so same levels, or increase in rent levels next academic year for student housing. And as we are voting, maybe, John, if I can ask you, is this rent on rent discounts or increases an issue for Coventry University?
No, I wouldn't have said so. There's been quite a lot of pressure on the accommodation this year in terms of giving refunds. And we gave significant refunds to students on the property that we own because the reputational damage to our university of not doing that would have been too high. Obviously, it's different if you are a private provider. So that's been more of the issue than that. I'd concur with Stuart's point around the occupancy rates, and there's a lot of new provision locally. I think it's quite a reasonably crowded market. For an organisation with 30,000 students, more than half can be placed in private, new, good quality residential accommodation.
Okay, thank you. For those who are on the phones, I read it. So what will be the impact on rent levels? Decrease 17% of the audience believe so. No increase, same levels, 57%. And increase 26% of the audience. So it's pretty much the winner is staying the same, or some of think increase or slight decrease. So there is relatively stable confidence around it. Last question, very short one, and I probably ask only Stuart here and Nigel, as they might be relevant to it. Costs. We have increased marketing costs in COVID, and we have increased health and safety costs, which are hitting the OPEX maybe in the zone of 1 or 2 extra percent, which is decreasing the NOI and valuation of the buildings. Is it really in line with your experience that this is about 1 to 2%, and will it stay after COVID in post-pandemic times? Therefore, the valuations of the buildings will be decreased.
Yes, I think that it probably will stay. It's become the norm now, and I think that that's fine. If I was to look across the entire portfolio, then I think that would be the case. If I was just to pick on the UK, and this is something that all the listeners have to be aware of, and the viewers of this, the real big kick this year is going to be around insurance, buildings insurance. We're seeing dramatic increase in that cost due to various fires and what have you. So I think that's going to be an element that needs to be considered in the UK market alone.
Nigel, your view?
In the short term, definitely, yes. Of course, it's affected OPEX, things like enhanced cleaning and stuff like that. I definitely concur with Stuart's point there on insurance. That has been a point that's come up. Looking slightly longer term, I'm say on the OPEX side in its entirety, it might be too early to say, because what we're seeing, and this is kind of thing that's been echoed across industry sectors. It's not just purpose-built student housing, not just real estate, but COVID has forced us to adopt technology quicker as it relates to things like the leasing journey, as it relates to things like providing amenity. And there, I think there is an opportunity for technological innovation to create operating efficiencies. So we've found those in parts. It really depends on how much of that sticks and how much that we can sort of roll out across the portfolio. So I think there's kind of two forces. So short term, definitely yes, increase in OpEx, and certainly in insurance. Longer term, it depends on how we utilize technology, I think.
Thank you, Nigel, and thank you all, gentlemen. I'm aware of time that we need to conclude just about. I would like to, on behalf of the audience, to thank you for your time and sharing the views and also some of your data. That was very appreciated to know where we are. I want to thank Richard again to give us the support here, as well as the audience to be engaging and voting and therefore enriching all of us. And hopefully this will go the way, as it seems that there is more applications, more investment confidence, reasonable costs and management around it. And that we will sort of meet again probably in 3 months in the same positive way. If you have more questions, please don't hesitate to kindly turn to us at Bonard. We will be happy to provide more data or assistance around research and knowledge of the asset class.